Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, welcoming you back for another weekly market recap featuring Lance Roberts. Hey, Lance, how you doing?
I'm fantastic. How are you?
I'm great. I really enjoyed the conversation we just had before the camera got rolling. Hopefully, we've still got some to leave on the field here. So let's jump right in.
I think what we need to do is we need to record the pre conversations, and we'll save them for one day. We'll use like a blooper reel. So the stuff you didn't hear that we talked about.
You know what? If folks are interested in that, let us know in the comments section below. And if there's enough interest, we will do exactly that.
The hidden files.
All right. So let's see. So this week we had kind of a mountain peak week where we started real strong. And then had some interesting things happen after Wednesday that brought prices back down a bit. We did close a little bit higher. I've got my theme for the week, but let's start with yours. What defined this week, Lance?
Well, oversold bounce. That's what this was. Last week on this conversation, we said, look, the market's very oversold, and we're very likely going to get a reflexive bounce here. Go back to last week. We were trading 3 standard deviations below the 50-day moving average. We were very negative in terms of investor sentiment, really across the board. American Association of Individual Investors, super bearish. Financial advisor bearishness was, at the peak. We run a technical composite in our newsletter every weekend, and that was, back to fairly oversold conditions. Not the March 2020 type lows that we saw back then, but not too far off of that. So the indicator runs from 0 to 100. We were at 29. So very oversold market, as of last week. So, the conditions were set up nicely for a reflexive bounce. Okay. So, well, Lance, what did you do with that reflexive bounce? That's the question, right? So this week we've been selling into that reflexive bounce. We've been trimming some exposure in some of our stocks, and we've actually been building a short position. So we've now got, as of yesterday, we've got a short S&P 500 in our portfolio, and we've been reducing our long exposure at the same time. So, we're slowly now, we're not convicted to this idea. And again, look, there's a lot of commentary out there about, we're about to be in a major bear market. A crash is coming. It's, just right around the corner any day now. Maybe. The thing that bothers me about that commentary is that when you have as many people talking about it as you have right now, it typically suggests we're not quite there yet. And what I mean by that is that markets never see a bear market coming. It's always after the fact, and everybody goes, oh yeah, that was the bear market. But there's so many people calling for a bear market right now. It's almost a contrarian bet to some degree. Now, I'm not, again, don't come yell at me and say you're wrong because Jeremy Grantham or John Husband or whatever said we're about to have a bear market. I'm not saying they're wrong at all. I'm just saying that historically speaking, you don't normally see as much bearish commentary about major market corrections, et cetera, as you see right now. That's typically more associated with at least a short-term bottom in the markets. Now, was the short-term bottom just what we saw this week? Is that all we're going to get? There is some indication of that. We had a nice rally back to the 50-day moving average. And if you take a look, the market from the October lows to the recent peak, we came back down and retested those October lows. So there's from a mathematical standpoint and technicals, there's a thing called Fibonacci retracements. And it's just uses a mathematical kind of Fibonacci formula of these retracement levels that run, kind of real basic 30%, 50%, 62%. And that's kind of the retracements. And normally what you get from a correction of the magnitude we had is at least a 50 to a 61.8% retracement. And that's what we actually got last week. We actually had a full 61.8% retracement last week, or this past week. So, we did have that rally. And now the question will be kind of what happens next. Do we get another sell-off back to the October lows? That would be very normal in terms of a normal market retest of the October lows. So, that's entirely possible at this point. The oversold condition that we had has been worked off some. The uber bearishness that we had has gone away here a little bit, but it's still pretty bearish in terms of the overall sentiment. So there's still some fuel here. And the reason I'm telling you this is I just don't want you to get overly bearish here. I've been getting a lot of emails this week. Is like, I'm getting out of the market. I'm going to be all into cash. I'm selling everything. That may well wind up being a great idea. The problem is what are you going to do if for some reason the Fed comes out in the next week or two and says, hey, look, inflation's slowing a lot faster than we thought. I'm not saying this is the case. I'm just laying out a premise. If you're all bet on one side of this basis and then the Fed comes out and does something different, we're not going to taper as fast as we said, or we're not going to hike rates as fast as we said, or surprise, the March meeting comes and instead of a 50 basis point hike, they don't hike at all. This market could very easily rally back to highs. And now you're caught trying to play catch up and trying to chase the market again. And that gets you on the wrong side of the ledger. So, as we talked about before here on this interview, is that portfolio management's a game about inches. It's like football. And we just want to make small changes, not big drastic ones, because that's how we get on the wrong side of the curve.
All right. Wow. Lots of great elements there in your summary. I took some notes here. Let me see if I can get them all.
Sorry.
First, let me start by giving you the kudos you deserve for having warned people over the past two episodes we've done that this bounce that did indeed materialize was probable. Was fairly probable, I think is the right way to say it.
Right.
You weren't saying it was definitely going to happen, but you were saying, hey, based upon all the indicators you look at, highly suggestive that there was a bounce coming. And we talked about how you took a bit of flack from some folks in the comments around that because to your point about being careful about being too bearish, there were a number of folks who were saying, no, Lance, you don't get it. This is it. This is the rollover right here. This is the big bust, right? And we had a really important conversation last week about confirmation bias and to make sure that you're aware of what your biases are, because that's really one of the biggest handicaps that individual investors have is we let our confirmation bias color our view of the world, and we're making decisions, basically on a skewed basis because we sort of have a thesis that we're in love with, right? So I appreciate that you're doing that here, even though you got the bounce. You're telling people, hey, you're now seeing a number of bearish indicators, but make sure that you're not just putting all your chips onto, okay, well, it's clearly going to roll over from here because of macro reason, X, Y, or Z, right? Sven Henrik, who's a very notable technical analyst, back when you were sort of predicting that, hey, you thought there was going to be a bounce coming, he has tons of charts, as you know, and there's a chart he found that I'll try to put up here while I'm talking. I got to go find it. But it was one of his technical charts basically showing that bounce off of the December lows, going back up to the 50-day moving average. And given his indicators, at least the chart I'm remembering, that opens the possibility, I'm not going to say probability, but the possibility of a much larger corrective wave down. In technical analysis, they have these sort of like A, B, C, D, E waves that they chart and whatnot. So I'm just going to put that up there just as a possible, trajectory that things could go from here. Now, of course, on the other hand, there are a number of other reasons why this market could continue to party on for a lot longer than people expect. It's funny, I talk to a lot of experts, and normally there's kind of a clear consensus. I would say in the past couple of weeks, it's been 50-50 in the folks I've talked to who think either we're going to have like a 20 to 30% correction as the Fed, finishes tapering and starts tightening. And then the Fed's going to basically, get chicken when the markets, are having that much pain, and it's going to start easing, and then it's going to be game on again. And there's about half people saying, nope, we're actually going to, go off to the races from here. And then we're going to hit some inflection point where the whole thing just collapses by probably a greater amount. Not saying one's right or the other, but I'm just saying even the really smart experts are kind of divided on this. And so you should be keeping the possibility open for, whatever you think is more probable. Keep the door open to the fact that what you think is less probable could still happen despite, all the evidence that you're seeing here. And of course, we had David Hunter on our program last week, who's got the probably the most bullish and most bearish predictions of anybody I've talked to. But he expects a historic melt up to go on for the next couple of months. I'm not saying that's going to happen, but I'm saying I would not give that a zero probability. Plan accordingly. So anyways, I'll hand it back to you here, Lance. I guess one thing I'd love to get into next year is we are still up for the week. We had some really big up days. I mean, days where the NASDAQ was up like 3% or more in a single day. What I found so interesting about this week is even though we're up for the week and we had some massive up days this week, my theme for the week would be the bigger they are, the harder they fall, because we had some of the biggest darlings of them all disappoint massively, and the market just punished them for that. And I'm thinking of guys like Facebook, down 25+%, PayPal, same deal. We saw this, the number of tech companies were kind of in that mix, not remembering them all, but Snap's one of them, where they were down in the aftermarket with PayPal, PayPal and Facebook, like 20-25% or something like that. But then they posted earnings the next day, and then they were up like 66%. So we're just seeing crazy volatility in the middle of all this too. But I think it is really interesting that, some of those darling FANG stocks, the bloom is coming off the rose. And, we've talked a lot about how those few stocks have been carrying this market for so long. A lot of people have just thought that those companies are invincible, but we're beginning to see some of these giants stumble. What do you think about that?
So two things. One, I'd like to step back just real quick. That's a great question. Want to get there. I'd like to step back just real quick. I don't want anybody to think that I'm calling for the next major bull market rally. And, Sven Heinrich is very correct in his analysis. If we do get into a bear market, this failure at the 50-day moving average would be very logical. A break of the October lows would certainly set us up for a deeper decline in the markets. Now, the question, of course, is where does the Fed panic and where do they get back in? A couple of things we've really got to pay attention to. At what level do we start triggering margin debt? And we've got record levels of margin debt. And if you start getting margin calls, that's going to accelerate the selling in the markets. So, one of the things we talked about previously is the biggest risk for the market is when we start getting a lot of these passive indexers start selling their ETFs, then that translates into the selling of the individual securities. And you have 360 of them are all on Apple. So when you start selling large cap ETFs, it just mills right through the rest of the market. So, don't mistake me at all that, I'm saying, hey, we're going to have a little, we're having this rally back to all-time highs and don't worry about the Fed. Look, the Fed's tightening monetary policy. They're raising interest rates. Liquidity is coming out of the markets. The economy's slowing down. Inflation is here. Despite the fact I think it's, we'll have more deflationary pressures down the road as that liquidity comes out of the markets. It's here now. And it's impacting profit margins across the board. Small caps, mid caps are the most vulnerable. So there is a lot of risks to this market. And I don't want anybody to misunderstand that. And that's why we're adding a short position to our portfolio. It's why we own bonds. It's why we're trimming our equity positions. We're just not getting completely out of the markets just in case. See, it's very easy. If I've got exposure to the market in a hedge, all I have to do to get back in the market is pull my hedge off, let my equities run, and then slowly start buying back into my equity positions as I become convicted that the market's going back up. If I have my equity position in a hedge and the market goes down, my hedge is hedging off some of that volatility risk in my portfolio so I can keep reducing my equities and increasing my hedge as the market goes down. I'm not going to time it perfect. My job is not to try to top tick the markets or bottom tick the markets. My job is to navigate it as we go up or down in the markets. And so, trying to guess what's going to happen is what's going to get you on the wrong side of the trade. Just respond to what the markets are telling you and follow the trend of the market. There's an old saying, trend is your friend, follow the trend. And right now, this is a very difficult point. Right here where we are in the market is no man's land. Market could go up from here. Market could go down from here. We don't know. And all of our indicators are now right back to the middle. So they're not bullish. They're not bearish. It's a terrible place to be in terms of technicals. But, we just got to kind of next week kind of work through this a little bit, but that's why we're being a little bit more cautious, because we're kind of in that no man's land of what the markets are going to do. So now let's jump back over to your question, because this is important. Facebook, I have no love for. So a lot of personal reasons I don't like Facebook. I think they're a societal disease, and that's a whole nother, that's one of those hidden files we'll have someday that we'll release. But they're a huge company. They make a lot of revenue. Now, the interesting thing is that they are a demographic time bomb. Talk to your kids and say, do you use Facebook? They'll tell you no. They use TikTok, they use Twitter, or Instagram, which is owned by Facebook. But TikTok is really starting to eat into the social media platforms. And we talked about this on our radio show last week, is that there's no barrier to entry for getting into social media. Adam, you and I could go start a social media platform. The barrier to entry is just the sheer size of YouTube and TikTok.
It's the network effect, but it's you can compete with it.
Yeah, right. So, so that's the issue. And so the problem with that is that TikTok is proving this, is that, hey, here's this little service that popped up, and all of a sudden it's starting to eat everybody's lunch, and nobody thought that could happen. And if you take a look at Facebook's, users, they've been declining for several years now, and just recently really showed that sharp decline. But this is that aging demographic. Older people use Facebook, but not the younger people. They're shifting off to other places, and they're flighty. TikTok this week, and it'll be BitBop next week, whatever it is, right? So they'll move to whatever the new cool thing is. And so Facebook's now made this decision that we're going to chase the metaverse. And that's a massively expensive proposition. They're talking billions of dollars of investment of that. And it's really a very unproven thing. I mean, it's is the metaverse going to be the thing? And I think there's a great movie out called Ready Player One, if you haven't seen it. But it kind of this whole idea of the metaverse, people live inside this metaverse and they live in sheer poverty, right? We've talked about the economic challenges we've gotten in the world, but everybody's kind of hiding in this metaverse. And it's kind of, science fiction becomes reality. And the question is can they actually monetize that? Can they actually make it work? And if you watch Ready Player One, and I highly suggest you watch it for the socioeconomic commentary, not so much the movie, but really watch it for the socioeconomic commentary. Facebook is the evil dark empire of Ready Player One. So I think it's a very interesting commentary. But to your point, we are seeing all of a sudden retail sales are slowing, consumer sales are slowing in a lot of areas. Look, Amazon was up 15% on Friday. Their earnings were not great. They had a one-time benefit from their Rivian position, which came onto their books. But if you take a look at their actual sales growth, revenue growth, et cetera, outside of the AWS, which is their cloud service, the other parts of their business really weren't firing on all cylinders. And that kind of tells you a little bit more about that's a very mature company now, and trying to support valuations where Amazon is trading is going to become a lot more difficult. Look, in all fairness, right? We're long Amazon. We own Amazon, we own Apple, we own Google, we own these major companies, because if we're going to compete with the index, which we have to compete with the index, those are the ones that drive that index. We sold Netflix, we've sold, other stuff. I will not, as a matter of conscience, own Facebook. So that's just one I'm never going to own. So sorry, if you're a Facebook fan, not trying to offend you, that's just me. But, so we have to own these positions to keep up with the index because of their sheer size and magnitude of weighting. But we're trimming off those positions that we own as we're seeing these earnings come in, because they do seem to be reaching that point to where growth is going to become more challenging. And if we have a disinflationary environment this year, if the economy slows down as we expect, that's going to become even more challenging for these companies to maintain these valuations. The only exception to that rule right now is Microsoft and Google, who just continue to grow at astronomical rates of growth, and they are probably the two best run companies on the planet. But everything else is a little bit suspect here.
All right, I want to just revisit a comment you've made in a previous one of these episodes we did, where you said it's sort of safe for money managers to hide out in those big companies, because if trouble's coming to the markets, those are going to be the last dominoes to fall. and they're likely going to take a slower path to them, right? Apple's not going to lose 30% of its value overnight. But
that was proven not true.
Well, exactly. I just want to zero in on the fact that Facebook lost 23% of its value overnight. Anybody who bought the stock or owned it, the day before, woke up the next morning, 23% poorer, at least in terms of that holding. So I just want to point out that they're not infallible. And I agree with your general point there, Lance. Yes, those are safer companies to park capital in or hide in or whatever word you used. But when we talk about confirmation bias and whatnot, we oftentimes tell ourselves, well, that'll never happen, right? That's an example that, hey, I think there was probably nobody around that thought that Facebook could lose that much market value in a single evening. I mean, it lost over $200 billion in one evening. It was just ridiculous.
Yeah,
right?
if you when I saw their earnings, I'm like, "Ooh, this is going to be bad. They're going to be down 5-6% tomorrow." Not 23. I wouldn't have suggested that you would have seen that big of a decline. It was, again, but it just goes to show you with this market, two things that are a real problem in this market remain the same today as we've talked about before: is liquidity. There is not a lot of liquidity. And one thing we talked about, I think on our very first episode we did together, is that when the selling comes, the problem with this market is that nobody wants to sell anything. So when prices are going up, I have to keep dragging sellers into the markets because they really don't want to sell. So I got to keep bidding up the price until I can find a seller to sell to, or to sell to me, right? The problem comes when all the sellers show up. There's really no buyers in the market. And as we saw with Facebook, buyers were there. They were just 23% lower. And that was where somebody was willing to go, yeah, I'll buy it, but it's down here where you're going to have to sell it. And that just goes, that type of lack of liquidity, especially for a company the size of Facebook, is very important, because it does go to show you that at some point you could wake up one morning, and I'm not saying, no, and look, I'm not saying this is going to happen, but a March 2020 type sell-off is not out of the cards. I mean, we could wake up one morning and be down 5-6% on the whole index. And that's because really there's not a lot of buyers in the market at this point. They're there, they're just at a lot lower price.
Yeah, and we keep talking about themes that we want to make one of these episodes around. One I'd really like to do very soon, because I think it's so important for folks to understand, is understanding how financial assets are priced at the margin. Because what you're talking about right here is the criticality of the marginal buyer, right? Just like a house on your street, right? One house sells, all the houses reprice, right? So the market value of your house is determined by that last transaction that happened. Mm-hmm. Well, if the last guy to buy bought the average house, for $1 million on the block, everyone's feeling good, right? But if the next house sells for $500,000, because that's just the maximum the next guy in line was willing to buy, all of a sudden the market value of the houses on that block are down by 50%, right? That's right. I'd like to really dig into that more with you when we have more time in one of these feature episodes, because I think most people really don't understand that, and it's that really gets, that risk becomes so much more exacerbated when volumes are low. That's like you're saying right now. That's right. All right, so I want to move on to again, sort of your trades of the week. Real quickly, I do want to make one comment just to build on something you said. So I mentioned that PayPal was one of these companies that was down by like 25% overnight too. Yeah. And one of the reasons was they own Venmo. So apparently PayPal had bought Venmo. I wasn't aware of that, but whatever. But Venmo, for folks that aren't aware of it, is sort of a person-to-person way to send money to people. It's a very easy way to send payments to people, your babysitter, whatever. And PayPal said, looking at the Venmo data, we're seeing that people are much less confident about making payments going forward now that all of the stimulus funds have kind of made their way through the system. So this, I think, is a really interesting early leading indicator of what may be happening with the economy going forward, because consumer spending is still like 70+% of the economy, and these guys have their finger, extremely close to the pulse of how the average person is spending money, or their appetite for spending money, and they're seeing the consumer tighten here. So I think that is another very important bearish indicator going forward.
Absolutely. And again, as we talked about before, what's going to drive this market ultimately is earnings. And look, we saw Google have great earnings. saw Microsoft have great earnings. Apple had great earnings. So when we look at those companies, there's a lot of companies reporting very, very good earnings. But big caveat here, but that's fourth quarter earnings. That was where there was still child tax credits in the system. That's where there was still some remnants of liquidity in the system from all the bailouts, the checks to households, et cetera, that was still kind of flowing through this. So there's a real risk here. And I want to caveat all this is because the reason I keep caveating myself is I don't want people to take something I say and they go, Lance said sell everything. That's not what I'm saying. I'm just trying to tell you things to watch out for. That may have been, in terms of earnings, the best that we're going to get for a while. In other words, that may have been the peak of earnings. It may be the peak of profit margins, et cetera. And in other words, those are all going to start to deteriorate as we get further in this year, which is going to make earnings estimates come down, which is going to make valuations go up, which means we're going to be paying more, but getting less. And so that's one thing to think about.
Right. And if inflation continues to rage hot, that's going to depress profit earnings as well, because it squeezes profit margins.
Right. And we're seeing that already. Profit margins are already declining outside of, small cap, mid cap space. You're already seeing a lot of profit margin squeeze there.
Okay. And I appreciate you can always qualify your statements just to make sure no one's, attributing some certainty to you that you don't want them to take away from there. Right. But I hope it's clear to everybody here that Lance's job in these videos is to read the tea leaves as he sees them this week. Right. And those leaves may change completely, from week to week. Right.
Exactly.
So, all right. So you mentioned that you were continuing to sell into this strength, and that you're actually adding some shorts along the way. You're laddering up the shorts like you talked about last week. Mm-hmm. You made a reference to bonds. I got to imagine that the bonds part of your portfolio that you've been recently adding is probably smarting a little bit as interest rates continue to jump up, but this is a longer term position that you're putting in there. Besides those three things, is there anything else you guys have done over this past week that are worth talking about?
No, yeah. Well, let's talk about the bond position, because I think that is important. So one thing we are doing is we owned a position in preferred stocks for a long time because of the yield, right? So remember, we have in our portfolios, we have a core equity position, we've got a core fixed income position. And the reason we carry a core fixed income position is to lower volatility of the overall portfolio and provide income. Well, with bonds yielding very low, we were using a dividend preferred stock proxy to create some additional income in our portfolios. So, we were using some preferred stocks yielding a little bit over 4%. So it helped bring the income side of our portfolio up. Now, with the yield curve really starting to invert here, which is telling you that you're having economic weakness is coming. I've got a chart in this weekend's newsletter showing the 6-month rate of change in the LEI, which is rolled over now and is deteriorating. Now, the Fed is going to hike rates into a leading economic index that is already declining. Again, this is a 6-month rate of change, not the index itself. In other words, the rate of growth of the LEI is slowing. The rate of our economic composite index is slowing. And that's a very broad index. It's over 100 different measures of the economy. So it's extremely broad, but that is rolled over as well. So you're seeing all these things come together now that suggest that yield curve is going to invert more. I don't want to own preferreds into a declining yield curve. They don't perform well there. They've been under pressure. So we've been selling that position off. The bond side of the portfolio, again, the way we manage the bond side is that we can go either super short, being cash, or we can go kind of sort of short, 1 to 3 year treasuries, 5 to 7, 7 to 10, 10 to 20, right? So, and we blend those to match our duration risk relative to what we are expecting out of the economy. So right now we're slowly lengthening. We saw a lot on the short end of the curve, a lot of floaters right now, but we're lengthening that curve or that duration of our bond portfolio to be more sensitive to interest rate declines. In other words, capital appreciation. To your point, yes, right now it's smarting a little bit because as we add into it coming down, those prices are still declining here, but every time it declines to a lower point, we're slowly increasing that duration. This is a longer term play. When the Fed starts to hike rates and when the yield curve inverts, interest rates in the long end will fall. It's just a function that interest rates are a function of economic growth. And if you get disinflation and a decline in economic growth, long-term yields are going to come down. And the more pressure you get on economic growth, the lower those yields are going to go. Our bet is, and if we're right, and our history, and by the way, this is just not me guessing, this is, studying 50 years of history. my bet is that by the time we get through this rate hiking scenario with the Fed and they stop hiking rates, that we're going to be somewhere below 1% on the 10-year treasury. And that's about a 15-20% gain on our bonds.
All right. And your bonds that you're buying, they're predominantly government bonds?
Yeah, treasuries.
Yeah. Okay, great.
Yeah.
And I presume you have a quite different opinion of corporate bonds in this environment.
No, actually, we have a portfolio that we run. So generally, when we're on here, we kind of talk about our core model. Our core model is a 60% stock, 40% fixed income portfolio, and from that model, we build a lot of different models. Okay, and so it's kind of think of it like a base model for a car, right? So it's the chassis, the engine, the transmission, et cetera, and I can put all different types of body styles on it, right? But it's still the kind of the same basic engine across the board. So that 60-40 model is kind of the base, and then from that we can build all different types of structures depending on client needs, et cetera. So for instance, like one portfolio that we run for high net worth families and family offices. And we actually buy corporate bonds in there. We own Ford bonds. We own some other stuff that, technically they're more junk rated, but these are very, good companies. We do a lot of fundamental research, debt payment structures, those type of things to make sure we don't have any credit risk. But no, there's actually some really good opportunities on the corporate side, but you've got to be really careful that you know how to analyze the company fundamentally. And again, that's the thing about bonds that people don't understand about the bond market because we don't talk about it near enough. But when you're buying bonds, it's all about fundamentals. It's credit risk, interest rate risk, economic risk, default risk, those type of things. That's what's priced into the yield of a bond. We did talk about this earlier, is that investors aren't getting paid for the risk that they take. But you need to, if you're going to buy individual bonds, you really need to understand how to analyze a balance sheet. Otherwise, I'd stay in treasuries and just protect yourself.
Yeah, and one of the reasons why I mentioned this is if the Fed blinks the way that you think, right, and they maybe even switch from hawkish to dovish again or whatever, then interest rates will come down. The Fed will be bringing, the markets will react very favorably to that. And if the Fed obviously stops hiking and maybe starts easing again, then bond prices are going to do great, right?
You're in trouble if that happens. Look, if you want to know what happened, real quick, if you want to know what happens with interest rates, just go back and look at 2018 when the Fed was hiking and tapering. Just look what happened with interest rates back then. Yeah.
Okay. So where I'm going with this though is in that case, both, in the case that the Fed basically, let's say, eases again, government debt and corporate debt is going to do great. But if we get into a crisis, let's say the other thing happens, right? Where the Uber bears are right and Jeremy Grantham's right, and we just go into a massive crisis here, 50% stock market crash, going into recession, et cetera. There's going to be a huge flight to safety into treasuries, and long-dated treasuries should probably do great then. It will, right? But corporate bonds may not, right? And that's the difference I'm trying to understand.
No, you're absolutely right. And let's go back to 2008 real quick. In 2008, so we were getting into the bear market. In June, we busted the head and shoulders pattern of the market. And so we started selling off all of our equities. And we were buying a lot of corporate bonds then because yields were really good. But again, going back to the fact, it's about buying fundamental quality, right? So you're buying fundamentals. But yeah, those bond prices for corporates got hammered during that whole thing. So as we were going through this credit crisis, those bond prices in these good quality companies were getting absolutely trashed. But as soon as we came out and, we did TARP, we did, the first QE and the market started coming back, all those bond prices.
That's the right time to buy those guys. Yeah, exactly.
Yeah. If we were buying some in October, November, December, we were buying companies that were on the verge, technically on the verge of bankruptcy. And we made a ton. I mean, I was buying Do you remember the whole blowout of the oil well with British Petroleum a few years back?
Absolutely. Yeah. Who doesn't?
The Macondo well, right? So when that happened, we went and looked at the balance sheet of British Petroleum and saw that, their liability was going to be $40 billion, which was worth roughly about a quarter's worth of revenue. We went and bought their bonds as fast as we could. And those bonds, we made a killing on those bonds. So the great thing about bonds is to remember, this is not bond ETFs. We're talking about real bonds, right? Actual bonds. They mature at face value. So if you, as long as you do the homework and you're fairly confident in your bet that that company's not going into bankruptcy, you can buy distressed debt. And look, Howard Marks at Oaktree is one of the masters at this, is buying distressed debt, and you can make an absolute fortune, if you're much better than equities, by buying distressed debt at the right time. But it's got to be the right quality companies. But the thing about owning bonds is, if you go through a bear market and you own the right type of bonds, yes, they'll go down in price, and you're going to look at your portfolio and go, oh my God, I'm losing money. But bonds mature at face value. That's the one benefit that stocks don't ever give you, is that stocks never mature at face value. Bonds will always give you your money back, again, providing that you invest in the right type of bonds. You'll get your money back no matter what happens in the interim. So that's why we own bonds. That's why we like them, because they provide stability, lower volatility, protection of principal, and they provide an income stream. And then we take the risk with the equity side of our portfolio.
All right, great explanation. I made a note here too to have one of these future videos zero in on bonds on a deep dive. Yeah. With that, I think we've, as usual, blown through our initial timing target for this. Hopefully, folks have enjoyed me letting rants run longer here. All right, so I do like to try to wrap up with some sort of more personalized advice to the folks that are watching here. Is there anything that either you guys at RIA are doing this week, or any kind of common mistake that you think people might be making in this type of market environment, or just any sort of like, hey, given what you're looking at this week, is there any bit of counsel you would give to our audience here?
Yeah, so two things. One, you talked about confirmation bias earlier. One of the greatest lines I heard this over the last couple of weeks was yes, I've obviously got confirmation bias because I'm always right. If that's your attitude about your positioning, you have confirmation bias. So you may want to go read some non things that you don't, go read some stuff you don't agree with. But it's easy when you go read stuff you don't agree with just to dismiss it. Don't dismiss it. Look, there's a lot of guys out there that I disagree with, and I read their work religiously. And I sit back and I think about it, and then I try to analyze why I still think they're wrong. And if I can't come up with a rational thesis why I really think they're wrong, either through historical data or whatever it is, then I have to really, incorporate that into my thinking. And that you've got to keep from that position of being all on one side of the coin, because if you're wrong, it's too hard to recover from. So, but going into next week, look, like I said, from your portfolio perspective, raise a little bit of cash here. You might be wrong. The market might go up and you're going to lag a little bit. It's better than the alternative at this point of having too much equity risk here. There's some things that are happening technically that don't look great. We ran into the 50-day moving average. We failed. We're our money flow indicator index that we track and talk about a lot, that is about halfway through its cycle. So there's not a lot of upside here. And the important thing is that if we do rally 50 days to the 50-day moving average, maybe a little bit higher, but we don't make new highs, and this market rolls over and breaks lows, we're going to have a very nicely defined head and shoulders pattern, which suggests now that you're going to have another 10 to 20% decline in the market. So that risk, is there. Like Sten Heinrich's talking about, that kind of pattern is there, and that is certainly a technical possibility that you certainly don't want to dismiss.
All right. Well, hopefully that, we'll look at how the tape actually plays out here. But if we find that we are indeed kind of making that right shoulder, hopefully the timing will be such that we'll be able to kind of let people know pretty soon after we see it on this channel. And even if I have to pull you on for a special one of these at a different time, if it's that time sensitive, but hopefully we'll help people keep track of this. But basically you're saying, look, if that right shoulder really does round out, hey, it might be Katie bar the door time, and that's when you really want to exercise caution.
Yeah, and look, one more thing here, real quick. I'm getting a lot of emails from people going, I want to participate when the market goes up, but I want to capture the downside when the market crashes. That's not realistic. You can capture some of the downside when it's going on, and again, what I mean by that is if you're trying to capture all the upside, then capture all the downside, then capture all the upside, you're going to wind up screwing up your portfolio royally and wind up losing money in both directions. That's timing the market. You can't do that. What you can do is, and just like we're doing, is look, we're building a short position in our portfolio. If the market declines, it'll benefit our portfolio and we'll sell it for a gain down the road. Then we'll take that money and we'll start buying into depressed equities that we like and still own at that point. So you can navigate the markets, but you can minimize the downside draw, but you can't effectively over and over again go, I'm gonna get all the downside and all of the upside and not wind up just losing money everywhere you turn. Because it just, I've been doing this for 35 years. I've never seen anybody do it successfully. I can't do it. I'm not even going to tell you I can do that successfully. But I think it's important because I'm getting a lot of emails going, I just want to capture the downside, upside. I don't want any, I don't want any in between. And that's just not the way money management works.
All right. Great wisdom. Thanks for setting the right expectation with folks, reminding them it's a game of probabilities. It's a game of averages. If you're trying to hit a grand slam on every single swing, you're probably going to strike out, almost every time.
Yep.
All right. Well, look, thanks so much, Lance. Everybody else, hope you enjoyed this. Please, if you like this new series with Lance, support this channel by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Lance, really look forward to seeing you next week, buddy.